What if one investor could turn a humble $10,000 into a staggering $163,000 in just 10 years, but end up with almost no spendable cash from it? Meanwhile, another investor with a much smaller portfolio was pocketing a cool $2,700 a year in passive income, paid right into their account without them lifting a finger. Who's the real winner? The person with the giant number on a screen, or the one with actual cash flowing into their bank? This is the dilemma every investor faces. It's the ultimate financial showdown: dividend stocks versus growth stocks. For years, investors have sworn allegiance to one side, convinced the other is a lost cause. One camp promises a slow, steady path to a comfortable retirement, paved with regular paychecks. The other promises a rocket ship of explosive growth with the potential to make generational wealth almost overnight. But what if the entire debate is a trap? What if the very idea of a versus battle is what's holding your portfolio back? By the end of this video, we're not just going to pick a winner. We're going to dismantle the myths, look at the hard data, and reveal the only strategy that truly wins. And I promise, the answer isn't what you think. Before we crown a champ, let's get to know the fighters in each corner. First up, in the blue corner, we have dividend stocks. Think of these as the reliable, established giants of the world, companies like Coca-Cola or Procter & Gamble. They've already had their explosive growth spurt. Now they're so consistently profitable, they have more cash than they know what to do with. So they share it with you, the shareholder, in the form of a dividend. It's a regular cash payment, usually every quarter, just for owning a piece of the company. The main draw here, that sweet, predictable income. And in the red corner, we have growth stocks. These are the young, hungry disruptors aiming for total domination. Think of a young Amazon or Tesla, or the innovative companies like Nvidia that are building the future. These companies aren't sending you a check. Why? Because every single dollar they make is fuel, plowed right back into the business to grow even faster. They're hiring, building, and researching to create the next big thing. When you buy a growth stock, you aren't looking for a quarterly paycheck. You're betting the company's value will absolutely skyrocket, letting you sell your shares for a massive profit down the road. So, to put it simply, dividend stocks pay you to stay. Growth stocks, you hope, will pay you a fortune when you leave. It's the classic tortoise versus the hare, slow and steady cash versus fast and explosive growth. So what's so great about being the tortoise? Why would anyone choose the slow and steady dividend path? Honestly, the reasons are incredibly strong. First and foremost, passive income. There's a real psychological comfort that comes from seeing cold, hard cash land in your account every 3 months, no matter what chaos the market is stirring up that day. This income is real. You can use it to pay bills, fund your retirement, or, and this is the secret sauce, reinvest it to buy even more shares. This kicks off a powerful compounding snowball that just gets bigger and bigger over time. Dividend stocks also tend to be less volatile. Since these are mature, stable businesses, their stock prices don't usually jump around as wildly as growth stocks. During a market panic, investors often run to the safety of dividend pairs. That dividend acts as a safety net. Even if the stock price dips, you're still getting paid. Research has shown that over the long run, dividends have made up a huge chunk of the stock market's total return. But the dividend world has its own set of dangers. You have to watch out for the dreaded yield trap. That's when a company has a super high dividend yield that looks too good to be true. Because it is. The yield is only high because the stock price has been tanking. A crazy high yield can be a massive red flag that the business is in trouble and might have to cut that dividend, sending the stock crashing even further. Smart dividend investing isn't about chasing the highest number. It's about finding quality companies that have a long history of increasing their dividend year after year. That's the real sign of a healthy business. Hey, if this is helping clear up the confusion and you're getting some value, do me a quick favor and hit that like button. It tells the algorithm that this is good stuff, and it helps the channel reach more people who are trying to get smart with their money. Thanks. Okay, now let's talk about the hare. Why would you bet on the fast-paced, high-risk world of growth stocks? The answer really is one word: potential. A dividend stock might hand you a 3 or 4% return in cash each year. Growth stock can deliver returns of 100%, 500%, or even 1,000% in just a few years. Think about the tech boom of the last decade. Companies in cloud computing, e-commerce, and AI delivered life-changing returns for people who got in early. This is how fortunes are made. Buying into a company like Microsoft or ASML before it was a household name can completely rewrite your financial story. The whole idea behind growth investing is that by reinvesting all profits, you are turbocharging the company's future. That growth in the company's value can be way more powerful than any dividend it could have paid out. There's another huge advantage that often gets overlooked: taxes. With dividend stocks, you're typically paying taxes on that income every year, whether you spend it or not. It's a small but constant drag on your growth. With growth stocks, you don't pay a dime in taxes until you sell. This lets your investment grow completely tax-free for years or even decades, maximizing the power of compounding. Of course, the downside is just as extreme as the upside. Growth stocks are famously volatile. Their prices are built on huge expectations, and if they stumble, the stock can absolutely collapse. For every Amazon, there are thousands of failed companies that burned through all their cash and went straight to zero. Investing in growth stocks requires a strong stomach and the ability to not panic when things get rocky. So we've met the contenders. One offers steady income, the other offers explosive growth. But which one is right for you? It really starts with your personal timeline. Are you close to retirement and need to start living off your investments? If so, the reliable cash flow from dividend stocks is probably the smarter play. Or are you young with decades ahead of you? You have time on your side to ride out the market swings and can afford to take more risks for a shot at those massive returns, making growth stocks look very attractive. Then there's your personal risk tolerance. Can you sleep at night knowing your portfolio could drug 30% in a bad month without panic selling at the absolute worst time? If the answer is no, the wild ride of growth stocks might give you an ulcer. The lower volatility of dividend stocks can be a much smoother journey, helping you stay the course. Finally, you have to look at the world around you. In times of economic uncertainty, the market tends to favor the predictable safety of dividend stocks. When the economy is booming and innovation is everywhere, growth stocks often take the lead and deliver spectacular results. So, after all that, after pitting them against each other, it's time to name the one true winner. The ultimate champion in the battle between dividend and growth stocks is neither, and both. Look, the real winner isn't Team Dividend or Team Growth. The only winner should be Team You. The biggest trap in this whole debate is thinking you have to pick a side. This isn't a sports rivalry, it's your financial future. The most successful, resilient, and bulletproof portfolios don't choose one. They intelligently combine the strengths of both. Think of it like building a championship sports team. You can't win with only offense, and you can't win with only defense. You need both. Dividend stocks are your defense. They provide stability, generate consistent cash flow, and guard your portfolio when the market gets ugly. Growth stocks are your offense. They're your star players, your high flyers, the ones who are going to score the big points and drive the massive long-term growth of your portfolio. When you blend them, you create something powerful. The cash from your dividend stocks can be used to buy more shares of your growth stocks, especially when the market dips and they're on sale. And the growth part of your portfolio gives you the firepower you need to crush inflation and build real wealth over time. So the next time someone asks if you're a dividend investor or a growth investor, you can tell them that's the wrong question. The smart investor is a blended investor. The winning strategy isn't about picking a team, it's about understanding your own goals, your timeline, and your comfort with risk. It's about building a diversified portfolio that uses the steady income of dividend payers and the explosive potential of growth innovators. For beginners, you can do this easily with low-cost index funds and ETFs that automatically give you a mix of both. The winner isn't a type of stock, it's a personalized strategy. And now you have the playbook to build yours. You're no longer stuck in a false choice. You're empowered to build a portfolio that truly works for you. So now I want to hear from you. Where do you lean? Are you Team Dividend, Team Growth, or have you already joined Team Blend? Let me know down in the comments. And if you want to learn more about how to actually put this stuff into practice, make sure you subscribe and hit that notification bell so you don't miss what's next. While you're at it, check out this next video where I break down the incredible power of compounding. It's the secret sauce that makes all of this work. Thanks for watching, and I'll see you in the next one.